Hello, everyone. Appreciate you making time to be on a webinar for the Gray Fund. We're going to just take a couple of minutes to allow some of the other registrants to hop in, and we're going to get started here in just a minute. If you'd like to learn more about the Gray Fund, obviously we're going to get into the structure, the strategy, current assets, pending assets. But again, if you'd like to learn more, please feel free to reach out to myself, Blake Peroni, if you've been in contact with him. And then in the chat feature, we've put the website for the landing page for the Gray Fund, again, with more information. And we'd be more than happy to send you over the full investment presentation for the fund, as well as the property supplementals that really take a deep dive into each asset, current assets of the fund, as well as some of our pending acquisitions that I'm looking forward to getting into in just a little bit of time. So again, we'll just take 1 or 2 more minutes before we get started. Looks like quite a few people are already here and ready to go. And again, I appreciate everyone taking the time out of your busy day to learn more about the Gray Fund, what we're up to at Gray Capital. We were just talking internally as a team. This has been a big year for us. A lot of progress, a lot of changes, a lot of good changes. We're consistently adding to our team. We've hired quite a few people over the last few months. And as we are, we're building out a property management firm and division at Gray Capital, Gray Residential, and we are certainly adding to our ranks associated with all of those changes as well. So a lot of exciting developments here at Gray Capital. All right, we'll just give it one more minute, and we'll get started. If you have any questions at any time, there is a chat feature. Please feel free to drop a question into the chat. Blake is on there. He'll be trying to respond if I don't get to it. If I don't see it, I will be taking some time at the end of the presentation to hop in and answer questions. If I see any in the meantime that's relevant, I'll certainly answer it right away as well. All right. Well, we've got quite a few people already here that are registered that are on, so let's just get started. Just first off, a quick disclaimer, the opportunity for the Gray Fund and any investment offerings from Gray Capital are only open to accredited investors. Certainly, always consult your own professional financial advisors, and this presentation isn't a specific offer to invest. A little bit about myself. My name is Spencer Gray. I'm co-founder, president, and CEO of Gray Capital, Gray Residential, and Gray Construction and Design. I started Gray Capital with my wife back in 2015. We started co-sponsoring projects with other sponsors. It was just my wife and I. We were investing some of our own capital that we had made from selling a previous business. And then over time started finding new partners and raising additional capital, and again doing a lot of co-sponsorships. I also started a family office, making not only co-investment in allocations but also LP investments, and that has really helped kind of shape my viewpoint of investing into multifamily assets, not just viewing it as a GP and a sponsor and thinking about the fees and some of the promoter carried interest. Truly putting our own money to work alongside of our investor partners creates a high alignment of interest. And we view these assets and investments just the way you would, and looking at it from how our capital will be utilized, used, and what types of yield and how it's going to grow over time. And that's how we've been able to create a significant alignment of interest. So today I'm going to talk about several things. One, just to give everyone a quick overview of Gray Capital if you're not familiar with us. I wanted to do a brief kind of multifamily market update, as we're living in absolute incredible times, not only in the multifamily market, but certainly as the global economy as a whole is in a transition period, and no one's really sure where it's going to go. And while we certainly don't have a crystal ball, and nobody does, the smartest people in the world really have no idea. They've gotten it wrong over and over again. I think that we can quantify certain aspects and make some smart decisions based on what we know today, and structure these investments in a way that minimizes downside, highlights the preservation of principal and capital, and sets us up for the success. And we have a couple strategies that aren't really necessarily new to Gray Capital, because we always take that capital preservation mindset, but I'll also highlight on some of the changes at Gray Capital that we've embarked on as the economy has changed and as the markets have changed over the last really 6 to 8 months. Also going to be talking about the Gray Fund, the structure, how it all works, how you can participate, and then get into the assets in the Gray Fund, the 2 active assets that we acquired earlier this year, and then go into detail on 3 pending acquisitions that we're really excited about. They'll be taking place, some by the end of this year and one early in 2023. Then at the end, we'll have a period for question and answers. Again, if you have a question in the meantime, feel free to drop it into the chat and we'll do our best to answer it as soon as possible. Again, if you'd like to know more information, just hop on over our website, graycapitalllc.com. We have rolled out a new website a little over a month ago. So if you haven't been to the website recently, go and check it out. We have a description of all of the properties in our portfolio, more information about the fund, the team, track record. So you can go ahead and check it out if you have not in a while. If you'd like to go directly to learn about the Gray Fund, you can just type in gray.fund into your browser, and that'll take you to the Gray Fund landing page. There you can request copies of the deck, property supplementals, as well as schedule a meeting with Blake and myself to discuss how the Gray Fund may work for you. So Gray Capital, as I mentioned, founded by my wife, Alex, and myself back in 2015. We started just as kind of a husband and wife team trying to make deals happen, raise money, and find good opportunities to place our own capital and our investor partners' capital. From that point of, again, just kind of partnering with folks that were a couple steps ahead of us, we're now proud to say we are a fully vertically integrated operation with property management, construction, design, as well as private equity and asset management as well. We've tried to be smart about how we scaled our company and waited to get to the moment where we were at the right economies of scale and the right size before taking something else on, because whether it's construction or property management, they're truly independent businesses and require specific skill sets and expertise. And we brought those on as it was necessary, and it's allowed us to not only move quicker, execute better, do things cheaper. The end result is having more control over our business plans and be able to execute the way we would like to execute. And it's been very beneficial to the firm, and we love seeing the team grow. We're Midwest specialists. We're based out of Indianapolis. The vast majority of our portfolio is in the Midwest, with, again, the majority being in the state of Indiana. We like investing in what we know. We've got a very good model that we've been successful at. I've been a sponsor of over 18 multifamily syndications, and we don't want to veer too far away from what has been successful. We get asked questions all the time of, are we going to begin developing multifamily assets, or are we going to start investing in self-storage or manufactured housing? And while those all seem like interesting opportunities, we know how to do this, and we do it really well. I think we do it as good as anybody out there with our own flavor and our own little kind of special sauce. And we just want to keep repeating that formula, still adapting and changing as the market changes. But again, finding what we're good at and successful at and continuing to double down. Since founding Gray Capital back in 2015, we've had the pleasure to be able to invest in over 10,000 multifamily apartment units. And currently we have over $700 million in multifamily assets under management. Since inception on full cycle projects, we've been able to deliver an IRR net to LPs of 29%. And we participated in over $1.5 billion of real estate projects. We'll have gone full cycle, going from acquisition to disposition, including refinances in the way on 10 multifamily projects by the end of this year. And I mentioned earlier about alignment of interest. Myself, the rest of the GP group, we are large investors in our own projects. We're often, not always, but very often, the largest single investor into these assets. Our average co-invest is 15%. It's been as high as 25% on some projects. This means two things. One, it's the alignment of interest that I discussed earlier of we're thinking in the same way that you're thinking about how to allocate your capital. It also means that you're investing with a well-capitalized partner. Not that other multifamily sponsors out there aren't somewhat well-capitalized, but you want to partner with someone that if there ever is a problem, whether it's beyond our control or not, we have the ability to bring capital to the table and make it right and make sure an investment is successful. We've never had a capital call for one of our projects, but you want to make sure that your sponsor, again, we're not using their last several dollars to get a deal done. And then what we truly focus on, because it's easy to say, not always easy to do, but on service to our investors, service to our residents, and then transparency and communication. We've increased the amount of reporting. Recently, we were doing quarterly reports. We have increased that frequency to doing monthly updates. They're not full reports, but essentially status updates, what's going on at each property every single month. And then on a quarterly basis, providing highly detailed financial reporting. We strive to be the best in the industry, bring more institutional reporting practices in-house, and we will strive to always continue to do better, and really proud what the team has been doing so far. What do we like to do? How do we kind of set ourselves apart? What excites us the most is exploiting inefficiencies. One, market inefficiencies, but also just the inefficiencies of real estate in general. Real estate it's an antiquated industry. It's slow moving. And there's so many opportunities to do things better and more efficiently, whether that's the use of technology, thinking about management in a different way. These are great opportunities that we find consistently, and it's how we've been able to create outsized returns. One of the main inefficiencies that we exploit is simply the discounting of our target region, the Midwest. The Midwest typically trades for higher cap rates than other markets, especially in the Sun Belt, and that allows us to achieve higher cash flow. But by finding submarkets that are growing as fast as any of the markets in the Sun Belt, strong population growth, high employment, high median income, that you would, again, find in the Sun Belt, but we are essentially arbitraging geography, buying at a higher cap rate, using the same debt, again, to provide higher degree of cash flow and overall higher returns. The result is often a return profile that is more focused on cash flow than just appreciation. We see that as just less speculation. Overall, the total returns end up being very similar, Midwest versus the Sun Belt. But again, we are cash flow investors. So being able to get that higher level of cash flow from inception aligns with our target return objectives. We're all about adding and creating lasting value, not just putting lipstick on something just to increase rents a couple bucks. We want to do the right thing for that asset, for the community. We believe that building a sense of community at these apartment properties is another way to add value. And by showing residents in the first days and couple weeks after an acquisition that we're here to improve the property, improve the asset, create a better environment. I can't tell you how many times we've come on to a property that we've acquired and just the bare minimum has been done. Residents are furious, and it can take some time to build that trust with residents, but it's something that we're dedicated to do. And again, it leads to higher retention, higher occupancies, and really being able to demonstrate the value, not just in new paint and new flooring and the new cosmetic renovations. That's all great, and we do that too, but truly showing the value that we're bringing to the properties, which translates to strong returns. And I mentioned this earlier, but keeping to our knitting and just doubling down what we've been successful at and not straying too far away and creating new strategies. Then finding new, better ways to execute. While we've had success, maybe there's a better way to do it. Maybe we can be more efficient. Again, trying new technology, different strategies. One example is the concept that we're going to be employing a great capital of building maintenance hubs in markets where we have economy of scale to be able to share resources between properties, not just between one or two properties, But when we have 3, 4 to 6 or 7 assets in a given market, being able to build economies of scale out of centralized facilities, so we can be very efficient with our maintenance staff, because being able to attract and retain quality maintenance personnel is one of the biggest challenges right now in the industry. So finding new ways to tackle that while also reducing expenses is just one example of just ways we're trying to do things a little bit better. We're all about quality over quantity. Jay Reeder, who's our Senior Vice President of Acquisitions and Asset Management, he'll tell you on the first day, he was our first hire, the first thing I told Jay is that we're never going to do a deal just to do a deal. We're going to do great deals, quality deals, and that may mean sitting on the sideline for a period of time until we find that right deal. We were on the sideline for a good chunk of this year. We weren't finding opportunities that checked all of our boxes that we felt comfortable with without participating in a great deal of speculation. Waiting for that right opportunity has, we've seen the benefits of that. And we're not in a hurry just to do a deal, even if when we have investors telling us we want to get something deployed, we want something to happen, but we're never going to do a deal just because we have money sitting there. Also, work as a team. I'm very proud and happy that the team that we have built and continue to build, it's the most exciting thing in doing all of this, not just doing great deals, but building a great team. We're all working in the same office. We're not remote. We're all here out of our Indianapolis headquarters, and we all get together every single day. This morning, we were all working out, climbing. There's a climbing gym attached to our office. Again, it's one of the things I'm the most proud of is the team that we've built and continue to build. Always looking for the win-win. It's a win-win between us, our investor partners, as well as residents. We always prefer that to any other type of outcome. And always we're looking at new, just creative ways to elevate communities, improve space, and provide high quality housing to our residents. Here's a quick snapshot of the team. And Matt, I don't know where Matt Bosnog was supposed to be in here somewhere. We lost his picture, but and we've made some new hires recently that aren't included in this slide that we are happy to introduce shortly. Oh, there's Matt. He added a transition for himself, looks like. All right. I would like to just give a brief multifamily market update. Things are different than they were several months ago, and certainly different than a year ago, and absolutely completely different than back before the pandemic. I just jotted down just kind of some of the concepts and things that are top of mind and make this a difficult environment to really decide the direction one wants to go. Certainly, we have higher and higher interest rates. Watching the 10-year Treasury today, we're well over 3.5%. I think closing to 3.6%, highest that it's been since 2011. Inflation remains high with no true signs of slowing down, although I think we'll see over the next few winter months how that shakes out. We're also seeing normalizing rent growth. Some people could say is there's no rental declines, but certainly that level of growth is coming down, which we anticipated seeing and we need to see, as the growth that we've seen in rents over the past really 18 months or so is relatively unsustainable relative to everything else. Low leverage, those higher interest rates, it means lower leverage, which decreases risk, but it also decreases returns. And as a firm trying to shoot for upper teens to 20s IRRs, it's difficult when we're using loan to values in the 50 to 65% range. And we're still able to do it on many opportunities, but it is a challenge and leads us to looking at twice as many opportunities, turning over that many more stones to be able to find that right opportunity. This is all leading to a lot of negative leverage in the multifamily space. Negative leverage is when your interest rate is higher than your cap rate. Historically, it's always been the other way around. You're buying at, call in 2019, we might be buying a mid-2000s asset for 6% cap rate. Your interest rate was around 4.5. Well, you had a nice spread between your cap rate and interest rate. Certainly, as you execute the business plan, your yield on cost or your cap rate certainly will increase and widens that spread. But many buyers have been purchasing assets again where their cap rate is in the threes, but now their interest rate is in the fives. So you're upside down on your leverage, and you have to grow out of that. And if you execute your business plan the right way, you often can grow out of it. But again, you're participating in a degree of speculation that many may not be comfortable with. And it's not something, again, as cash flow investors with a focus on a preservation of principal, it's not something that we're comfortable doing. And I'm happy to report that the three assets that we are going to be discussing just a little bit later all are using positive leverage. We're able to avoid using negative leverage. It's not easy to do. And it was one of the reasons why we didn't think we would have any other acquisitions by the end of this year. But fortunately, it's that patience has paid dividends. So those are some of the negatives. We also have housing shortage going on right now. We have around 4 million housing units that we need to create by 2035. Now, on the flip side, single family homes are incredibly unaffordable as mortgage rates have increased. They're in the mid sixes right now. Such a smaller and smaller number of individuals can afford a payment on a mortgage, let alone qualify, especially when it comes to millennials who would have been entering that period of their life where they're buying that starter home, they're starting a family, but we're seeing those decisions being put off longer and longer, and that's resulting in a higher percentage of renters. A lot of individuals who were renters by choice, they could have afforded a home, they are now renter by necessity, and they are going to be renting for quite a bit of time. Now, if home prices come down and interest rates come down, some will certainly go back into that market, but many others are just coming to terms with they're not going to be buying a single family home in the near future. This scenario also is leading us to focus a little bit more on the higher end of the spectrum, really B plus through A class assets, as a lot of the renters, they have the incomes to spend, they just may not qualify for that home. Again, we're seeing global economic uncertainty. We don't know where the economy is going to go in the next few years. Many predictions for global recessions coming up. Now, I believe the United States is going to fare significantly better than any other nation in the world for a variety of reasons. I wouldn't want to be investing anywhere else in the world besides the United States. And I think multifamily has some incredible, compelling prospects, especially when we compare the alternatives. Again, here's just a quick snapshot of what's going on right now. I mean, the yield curve is deeply inverted between the 2s and 10s. I believe the two-year treasury is almost yielding 4% currently, which is absolutely incredible. But we do see some signs that inflation may be coming down. Even we have a decently higher CPI print last week. But copper prices are falling, energy prices have fallen. Not a lot of movement in the labor market, although on this report, some signs of cracking may be present. But again, it's a little uncertain. So we have to beg the question of, where do we go? Apartment rent growth is slowing, but as we've seen, the growth has been incredible. We're not really seeing any declines, more of a leveling off and a returning to normal. Again, these are just some charts showing the rent growth over the past several years. Now, we're entering a time of the year where we naturally see some flattening in rent growth. Often we see some rent declines in the winter months. It's a slow season. People are back at school. It's cold, just not leasing as many apartments. Apartment owners are doing whatever they can to increase occupancy. So it'll be very interesting to see how rents are affected this winter, and then if and how much they bounce back in spring when we get into leasing season around March and April. Back to income growth and rent growth. When I read this report from RealPage, it surprised me a little bit of how incomes have actually been able to keep up with many of these rent increases. Now, this is a same store study looking at several thousand different apartment units. And this really illustrates two points I'd like to make. One is that incomes are rising. They're not outpacing inflation, but many of them are being able to track rent growth. But if you see this divergence here between these two lines, between effective and in-place rent, typically that spread has been relatively narrow. Again, the in-place rent is what the is essentially the rent that is being paid at the property by current residents. Now, the asking rent or your market rent is what one might see on apartments.com or is listed on the website. A prospect walks in off the street, and that is what they're quoted for that day. It's an incredibly wide gap, and there will still be time for the in-place rent to catch up with the new market rents that has been being absorbed, but we still have a good 18 to 24 months of absorption between market rents and effective rents. And so that'll be interesting to play out. So even without future market rent growth, we will still see effective rent growth over the next several months to several years. Quick snapshot of several different markets. And I know this is a little small, but one thing I wanted to point out is that Indianapolis, which is where we're headquartered, a lot of our portfolio, it doesn't always hit the headlines of top multifamily markets, which we like that to keep. Again, it's that geographic arbitrage. People are going to go elsewhere. Indianapolis is actually in the top 10 of rent growth year over year. A lot of other markets are much more volatile. The Midwest is a little bit more stable, and we just don't see the declines that some of the high growth markets tend to see. This is a study that Berkadia did looking at apartment performance in different inflationary environments, as well as different volatility in the 10-year treasury environment. You can see that a higher inflationary environment is a major benefactor for levered apartment returns. Really anywhere over 1% to 4%, it's a major driver, a little dip in the 4 to 7. But as inflation increases, rents are historically are always able to track and keep up with inflation. There's less of a correlation between apartment returns and the 10-year treasury, however. It's really all over the board. So as we see the 10-year treasury increase, it doesn't necessarily immediately affect apartment returns, although that cost of capital is incredibly important. And that's why we're watching where cap rates are going to be going over the next year or so as well, because that relationship is definitely key to understand that cap rate and interest rate spread. So where do we go? If you have capital sitting on the sidelines, inflation is certainly destroying the value of cash at the moment. And so if we're of the mindset of we need to keep our capital working, what are our options? And looking at whether it's the S&P 500, bonds, multifamily, commercial real estate in general is still one of the best places to be. If we look at leveraged core property as well as value-added assets and total returns over a 10-year period, both outperform the S&P 500, not even including the tax benefits that are associated with commercial real estate. But one point to make is do not confuse private real estate with REITs. REITs are much more volatile and have a different return outcome and profile than actually investing in real hard assets, which REITs are, much more paper real estate and just behave differently, especially in this type of environment. Just another example of this is again from Berkadia. Just again, apartment returns. This is from 1987 through today. Looking at quasi-stagflation environments, which we haven't had too many. So it's probably not the best analog of today, which we don't really have too many great analogs. But as close as we can get, again, apartment returns outpace the Wilshire 5000 as well as the NASDAQ. So let's get into the Gray Fund. Currently in the Gray Fund, we have 2 active assets, 3 pending assets, with a target of 7 to 10 multifamily properties by the end of Q4 of 2023. Total target fund equity is $100 million, and the total value of the fund itself around $300 million. Now that may change a little bit as we are using lower leverage than we had initially planned for based on kind of the capital market environment. The term of the fund is 5 to 10 years, and then we may hold assets shorter than that 5-year period. But I think the duration, I think, is incredibly important. Again, when we come back to capital preservation, if we have a 3-year target of where we have to sell an asset in 3 years, or certainly sell out an entire fund in 3 years, that's threading a needle in an economic environment that is questionable. If we have the time, our chance of success goes up significantly. Now, certainly a higher velocity of transactions will increase returns. And so if we have an opportunity to put a win on the board in year 3, if we've completed our business plan, forced appreciation, it's an opportunity that I think we have to take advantage of. But financing these assets and building the business plans in a way that we have the duration and the longevity to not only accomplish our business plans, but also hold on through a variety of economic downturns. We typically overcapitalize our project, bring more cash reserves on than are necessary, and really more than I see most other groups doing. One, make sure that if anything breaks, we can fix it. But second, we can make sure that we can keep these assets going. If we ever see a major economic downturn, we're prepared. We are ready to batten down the hatches and get through the storm. The fund features monthly distributions. Again, I mentioned monthly status updates and reports with longer form quarterly reports. We currently have investment minimum for the fund of $100,000. We do have an opportunity to invest directly into our projects, but the minimum is quite a bit higher. We have a dual class equity structure for the Gray Fund. A class units and B class units. Our A units are focused on income, feature a 10% preferred return. And then our B units, which are focused on growth. The A units are in a prioritized position in the capital stack, which means that they are paid first. They're the lowest risk. If we have a large return of capital, the A unit investors get paid back, and followed by the B unit members. Now, normal distributions, cash flow still flows to those B unit investors, but only after that 10% has been delivered to A unit investors. Now, we're able to achieve that type of monthly distribution in 10% because the properties don't just throw off 10% project cash on cash year 1. That'd be very difficult to do. But the A class units only comprise 25% of the overall fund equity, which means we only have to hit a 2.5% cash on cash return to meet that 10% return hurdle. 2.5% is well below what we need to see in year 1 cash flow. So when we've already begun distributing on the B units just within the first year of the fund. We've hit every distribution for the A units, the full 10%, and those B units have begun to distribute as well. Now, after the 10% for the A units, there is no further upside. So you hit your 10%, it flows to the B. Again, if there's a capital event, the A units are paid back first. And once their capital has been fully returned, they no longer receive distributions. All the excess profit flows to the B class unit. So if you are an investor that's really focused on overall total return and IRR, I'm not as focused on cash flow, the B units are a great option. They feature a 7% preferred return, an 80-20 split between the LP and the GP. We don't have a second waterfall until after an 18% IRR, but we're still shooting for kind of an 18 to mid 20s IRR. But you don't have to kind of go one or the other. You can bifurcate your investment between A and B class units. And this graph kind of illustrates what some of those return profiles look like. And so, but not only look at it from your return profile and how much cash flow you're going to receive and potential overall total return, it's also related to risk because you're also moving up and down in the capital stack. Again, those A units being paid back first, the chance of having a loss in that capital is significantly lower compared to the B class units. So being able to invest in a combination of A and B units allows you to really build a tailored risk and return profile. So for example, we covered both either all A or all B. The second most popular allocation so far for Gray Fund investors has been 75% B units and 25% A units. That comes out to an average blended preferred return of 7.75%. I'm in a projected IRR of around 17.5%. Equity multiple kind of right at 3x. Again, these are projections over a 10-year hold. But also balance would probably be the second most popular allocation. That's 50-50 between A and B. You're getting an 8.5% blended preferred return and still projecting to get a 15% IRR, equity multiple just under 2.5. Now, the third option would be coming be a much more focus on income. So 75% A, 25% B, blended pref of 9.25, an IRR still of 12.5. So if this is for someone who has a strong focus on income, but would like to see a little bit more of upside, this would be a good option as well. And then of course you can go 100% A or 100% B as well. A little bit about kind of the criteria that we're looking for acquisitions for the fund, and our kind of our general strategy. In all of this information, we go into much more detail on the Gray Fund investment deck. So, please feel free to reach out to myself or Blake. We'd be happy to send this over to you if you don't already have it. We're investing in the Midwest. Our primary states that we're looking at are Indiana, Ohio, Kentucky, and Michigan. Growing secondary and tertiary markets. We want to see growing population, growing jobs, growing incomes. We like tax and business friendly markets. That's why we like the Midwest, and the states that we've chosen to invest in the Midwest, in the states that we've chosen to exclude, such as Illinois in the Midwest, just because the laws and tax regime are just not as favorable. And we want to see some clear economic drivers and really just steady long history of economic growth. We're looking at value add and core plus assets. More of the assets we're looking at now fall more into that light value add or core plus. I think that's where the sweet spot is today. And by, again, bringing property management in-house allows us to just execute that much more efficient. Again, these are a list of handful of our target markets, quite a few in Indiana, Ohio, and Kentucky, in Michigan as well, and then a handful of markets that are on our radar. Some of the fees for the fund, we have an asset management fee of 1.75 of deployed capital. We have a range of acquisition fees. We have a max of 1.5. Our lowest acquisition fee today has been 75 basis points, and we've gone up on smaller projects to the 1.5. Property management fee, we have a max of 3.75. Typically, we're closer to 3%. And then a loan origination fee at a 1% max fee. Again, our minimums for the fund are $100,000. And if you're interested in going directly into a project and having a major concentration in a particular asset, we do have a relatively high bar to do that, a $1 million minimum investment. Let's talk about some of the two current assets that we have in the fund, and then three very exciting opportunities that are going to be coming up here in the very near future. The first asset that was acquired earlier this year in June in Indianapolis was Stony Brook Commons. It's 122 units built in 1992. We have a light value add strategy. We've already gotten a lot of work done. And again, if we weren't managing these construction projects on our own, a lot of this would not have been able to be done in time. We've replaced all the roofs at the property. We have done a new seal and stripe on the asphalt. We've been completing masonry repairs, and we're really rolling out our interior unit renovations in Q4. We've been able to get great just lease trade outs organically without doing any interior unit renovations, which is a theme really that you'll hear a couple times today on today's presentation. And if you're invested in other multifamily assets, you're probably hearing a lot of that also. It's just the organic growth is so strong right now. You're almost achieving much of your post-renovation rent premiums without really doing much at all. Property is currently occupied at 93.4% and is doing well. We still have a lot of work to do, but so far, so good. Club Meridian is the second asset in the fund. It was acquired at the end of July. It's located in a suburb of Lansing, Michigan, in Okemos. 406 units. It was built in 1989. It's value add, more of a light value add, but I'll just call it a value add. Projected IRR in the 17.5 to 22.75 range, depending on year of exit, and projected cash on cash of 10.53 over a 10-year hold. Club Meridian is one of the better performing assets in our entire Gray Capital portfolio right now. It's going very well. We've also completed new asphalt seal and stripe. We're working on a minor pool repair with a full pool of renovation in spring. We have taken some time to repair quite a bit of the carports that is underway currently. And then we're going to begin our interior upgrades in Q4. But the lease trade outs up at Club Meridian have been absolutely incredible. We're getting averaging 21.9% on trade outs. That's a premium of $234 per month without doing interior renovations. Now we're going to be rolling out interior renovations shortly, which we believe will get an additional premium for. Where we're actually required from our lender to do a certain amount of interior upgrades. But we are already outpacing our business plan without even putting that money to work yet. Occupancy is strong at 94%. We've got a great on-site team up there. So far it's been a great asset to manage. All right, let's look at some of these upcoming acquisitions. So I had to take the name off of them. So this asset, Fund 3 asset, it's pending. We'll be under contract tomorrow. So if the webinar was tomorrow, I could put the name out there. You might be able to figure it out just with this information. But just to be safe, we haven't included the name of the asset. It's in Terre Haute, Indiana, which is about an hour west of Indianapolis. It's 250 units, built in 2012. It's really a core plus strategy, a very light value add. Essentially, we have to repaint the exterior. But that's about it. It's in great shape. It was developed by a local developer. Actually, they're based out of Terre Haute, although they have an office in Indianapolis as well. We've purchased another asset that they developed up in Granger, Indiana, just outside of South Bend. We're very familiar with this developer, how they build, the quality, and how to manage these assets. This is essentially a slightly earlier version of the property that we already own, with attached garages, great amenity set, great pool. So we know how to operate this type of asset. And so we're really excited to be able to pick up another one that was developed from this group. They're not the same seller. They've already sold it. We're purchasing it from a REIT, but very excited. Just in the area, well, before I get into the area, we're purchasing at a 5.45 cap rate on their T12. If you are following the multifamily industry, you really haven't seen much trade for anything even close to a 5. It's all been in the mid 4s. We were not the first buyer for this asset. A couple other groups, a group backed out, and we kind of came in and said, look, we love the property. Terre Haute's a little bit more of a tertiary market for us. We need to see some very strong returns. We're comfortable with the market. It's in a great location in Terre Haute. But it needs to be very attractive for us. And we were able to get a great price. Again, a 5.4 cap rate. And that allows us to have positive leverage, even with new debt. 65% LTV is our target. We may have to go down as low as 60%. But we are able to get it positively levered, and that's going to lead to strong cash flow out of the gate. Strong incomes in the area, over 100K average income within a 1 mile radius. And there's a ton of development in the immediate area. The largest of which is a large casino, $200 million Queen of Terre Haute casino that is being developed down the street. That's going to have 500 permanent jobs over the next several years. We anticipate closing on this property kind of at the end of November. So this will be the first in next asset in the Gray Fund. Just looking at I try to keep saying the property's name. Rents are below market. Now it's the best asset in the market. So the rents are near the top, but again, there truly are not very many, if really any at all, true comps to this property. It is the nicest property in Terre Haute, especially on this side of town in suburban eastern Terre Haute. You can see it's a suburban setting, but you can see all this new development. All of this retail is essentially brand new over the last 5 to 7 years. New Aldi grocery store, Meijer, new Walmart, quite a bit of other retail and restaurants, and as well as this casino that is going to be going in near I-70 in the near future. They broke ground in June, so it is underway. Looking at the cash flow for the property, don't look in the top right corner. Very strong, average 10%, break-even occupancy 60%, starting out of the gate. 6.68%. Most of the deals we've underwritten have been cash flowing in the 3 to 5% range. So to see one over 6 was very exciting. Looking at a sensitivity analysis on an IRR basis, comparing exit cap rates and hold periods, we're assuming a 6% exit cap rate. That's quite a bit more than that we would typically underwrite, but we felt it was appropriate because it is a little bit more of a tertiary market, and we just don't know what type of economic situation we are going to find ourselves in. But even in stretching it all the way out to a 7 cap, you can see that after the 5th year, we're in the mid-teens IRR. So even if we see major cap rate expansion, we're not only looking at a still profitable investment, but an investment that still outpaces most of the major stock indices. And if cap rates remain even elevated to where they are today, we're looking at a kind of a mid-17s to 20% IRR. And if we get any kind of cap rate compression, or even sell it at a cap rate that we are purchasing at, or even above, we're looking at high 17s to low mid-20s IRR. All right, the next asset that is pending in the Gray Fund portfolio is a 154-unit A-class asset in Bloomington, Indiana. Bloomington, Indiana is about an hour south of Indianapolis, home to Indiana University, and several large medical device manufacturers and quite a few advanced manufacturing firms as well. Really nice diversified economy. It was built in 2016. It's a core plus strategy. There's not a whole lot of work to do here from a kind of physical property improvement standpoint, but there is a ton of meat on the bone when it comes to management efficiencies and really just managing the asset the way it should have been. The foot has essentially been kind of taken off the gas from the current ownership. They have not been pushing rents, which I'll show a chart here in just a moment that really illustrates it. So the rents are quite a bit below market. And we're not pushing rents as hard as we can, I think, in our pro forma, but even where we are projecting, we're looking at IRRs in kind of the mid 14s up to 17.5, mid 7s average cash on cash. And one of the, again, very exciting, hard to do these days. We have the opportunity to assume the in-place loan. It still has 7 years of term, 3 years of interest only, and we're assuming a 3.4% interest rate at a 65% loan to value. So at the same loan to value that we could get on a new loan today, but with a 3.4% interest rate versus the 5 to 5.6 that we would get on a new loan. There's a tremendous amount of value just being able to assume this loan, and we're not paying a premium on it. Partially because this is a off-market opportunity, direct from the seller. So very excited for this project. Also because we have a neighboring property where we're going to be able to find a lot of efficiencies in sharing staff, and again, sharing some of those maintenance personnel between our Forest Ridge property and this future Gray Fund asset. We're looking to close on this property mid-December. It says 23, but it's this year. Looking at some of the comps for this Bloomington asset, again, the rents are quite a bit below market comps. Again, this is a 2016 built asset. We only have a couple pictures, but it's great amenities, great pool, everything that someone living in Bloomington would want to have. And again, just like a lot of room to move rents closer to market. In this graphic, now let me move my icon here just so you can actually see what I want you to see. In this graph to your right is looking at market rent growth in Bloomington, the United States, as well as the property itself. In this line, here, let me turn on the whiteboard so you all can see it. This line right here, that is the rent growth for the property itself. And you can see it, it's essentially flatlined, where the rest of the market, the Bloomington market, as well as the national market, has been increasing quite a bit. The rents just were not pushed, and they have essentially been left stagnant. So we see that as a major opportunity to simply just bring those rents to market at the appropriate levels that they should be at. Looking at cash flow, a little bit lower than Sycamore Terrace, but still strong, 6.43% year one, going to 7.5%. 7.7%. Basically, then once interest only burns off, we go back down to 6% and climb from there. And relatively low break-even occupancy. We need to hit on average below a 65% physical occupancy to not be able to pay our mortgage. Looking at sensitivity analysis from a total return and IRR standpoint, between a 5 and 10 year hold, we're anywhere between essentially 14.5 all the way up to 17.7. That's assuming a 5% exit cap rate. Again, but if we go out to all the way a 6% exit cap rate, we're still kind of in a low teens environment, still making decent returns and still outpacing most of the major stock indices. Now, for the last fund asset to talk about today, I do not have as much information because we're still a little bit early. This is another off-market opportunity, so it is in the works. It's moving forward, but we just don't have the full presentation to share with you today. It's located in Brownsburg, Indiana, which is a suburban submarket on the northwest side of Indianapolis. We've been tracking this property for quite some time. We know the seller quite well. So we're very excited to be able to acquire this asset. Great demographics in Brownsburg itself. 172 units for the property, also built in 2016, also assuming a low interest rate, assuming the loan on it. But the 12% population growth over between 2022 and 2027. So very strong population growth within just a 1 mile radius. We anticipate that we will close on this property. We'd love to close before the end of the year. Bonus and accelerated depreciation starts to be phased out in 2023. It goes from 100% to 80%. We'd love to take full advantage of all that accelerated depreciation from this asset this year. We're hoping we're able to make some progress and get it in before the end of the year. But right now we have it penciled in for January of 23. If you'd like to learn more about any of these properties, the Gray Fund, send us an email, myself, Spencer, at graycapitalllc.com, or shoot Blake an email, blake@graycapitalllc.com. Also, you can go to our website, graycapitalllc.com, if I haven't said that enough times, or gray.fund for more information. Now I'd like to hop into questions. I've got some other things I can share, but I'd love to just kind of get into some Q&A. So if you'd like to ask any specific questions on any of the particular properties, the multifamily market, the fund itself, be happy to go into any of those details. David said, Blake, great to see you. Is the slide available? Yeah, absolutely. You just reach out to shoot Blake an email and we'll be happy to get you over those slides. No, thanks for watching, David. Steve, what are the anticipated loan terms for the Terre Haute property? So we're looking at a fixed rate agency loan, 10-year term, looking at about 5 years of interest only. The 10-year treasury is moving around quite a bit. We have not locked our rate currently. Right now we're anywhere between kind of a 5 and 5.5% interest rate. Fortunately, again, with the cap rate that we're still able to get positive leverage, even if the 10-year continues to run. And we've stress test the interest rate on Terre Haute really up to 6%. And at 6%, we're getting into negative leverage territory, but we still have strong returns. So currently, again, we're assuming kind of that mid 5% interest rate. But again, we'll really have to see how the capital markets shake out over the next week or so. No, absolutely, Rob. Appreciate you attending. And everyone, thank you so much for taking time out of your busy day to listen to this presentation, view the webinar. A couple of other notes, and please continue to ask questions if you have any in the chat. But just a couple notes just on the status of fundraising. We are, surprisingly, we had more interest for our B units at the last fundraise than A units. We still are right at that 75-25 balance between A and B units. We're getting a ton of interest from investors for our A units. And we are approaching the point where we're going to be oversubscribed for our A units. If you are interested, please get in touch with us sooner rather than later to let us know your allocation interest, whether that's all A, B, or a variety. We may have to start a wait list for our A class units shortly. So just if you are interested in some of those A units, please let us know right away. We should have some B units available for, I'd say, the next several weeks. We're getting some strong commitments from some more institutional investors of what their commitments will be. So the sooner you are able to make your commitment, the sooner that we can kind of lock you in and reserve your space. Certainly want you to be able to do all the due diligence, ask any questions that you would like to. So please reach out to Blake or myself to schedule a meeting, or you can go to that gray.fund, and there is a meeting scheduler with our calendars on that page to find the best time for you to meet and discuss the fund. And again, happy to go into as many details on the properties as you'd like. For each project, with the exception of Union Green, just because it's a little bit early, we have full property supplementals, 25 to 35 page documents going into quite a bit of detail on the business plans, projections, comps, everything you'd want to see to be able to make your decision on each asset. Some funds may only provide, a page or two about the assets in the fund, mostly talk about the fund. We treat each acquisition on its own. We're also looking at portfolio construction to make sure it's a good balance for the portfolio of the fund itself. But we're putting in just as much, if not more, energy and effort into each individual acquisition than we did compared when we were just doing single asset syndications and single asset raises. So happy to go into any of those details. Absolutely, Rob. Well, again, I'm just going to stick on for another minute or two. Just if anyone has any other questions, if you are the type of person that prefers to not have a phone call and talk to someone, I understand that. We have a Gray Capital investment portal. You can go to graycapitalllc.com. It just takes a couple minutes to create an account, and you can pop right in and make your full commitment just on our investment portal on our website. Again, you just review the fund documents, sign a subscription document, decide your allocation between A and B units, fund your investment, and you are ready to go. Again, if you need any help going through the investment portal, feel free to reach out. Blake would usually be the best person to reach out to, Blake at graycapitalllc.com. So yeah, I hope everyone has a great rest of their week. Everyone does well. And again, looking forward to partnering with all or most of you on these upcoming transactions. And just be on the lookout, as we're going to have some new announcements coming up shortly. These projects, once we are fully under contract, we'll be able to share a ton more details. So you will be hearing from us sooner rather than later. All right. We're approaching the 1 hour mark. If there's no other questions, again, hope everyone has a great day, and we'll talk to you soon. Thank you.